We're going to look at a sample problem here dealing with purchasing a fixed asset, and we're going to get charged some interest for that purchase. So we will accrue that at year end, because remember, the reason we do that is because we have to recognize our expenses in the year that they're incurred and match those against the revenues that are earned throughout that same period. That satisfies our matching principle. And part of the cost of doing business is doing stuff on credit where we get charged interest. So that's why we'll accrue it at year end. So here's our scenario. On May 1st, we purchased a piece of equipment. It's a 1-year note, 3%. We're going to, at year end, that year has not been completely satisfied yet, so the note isn't due, but the interest has still accrued, so we're going to accrue for that for year end. And then on May 1st, we're going to go ahead and pay off that note plus all the interest when the note is due. So we're going to go through and do those journal entries. So the first one here, we purchased the equipment. We have to use and follow the cost principle. When we purchase fixed assets, we always record those at cost. So this equipment cost us $12,000, so that's what we'll book it for. So debiting that asset account for $12,000, and we're going to credit the liability account notes payable. We're going to owe them $12,000 for that note. We don't record any interest here because interest has not been incurred yet. Okay, but on year end, we have used their money to buy this piece of equipment for May, June, July, August, September, October, November, and December. So all 8 months there of that year, we need to accrue interest. So our principal interest is figured this way. Interest equals PRT. Interest equals principal times rate times time. So our principal is $12,000. The rate that we give you for the note is always an annual rate, so we multiply that times the 3%, and then we want to make that for a partial year because 3% represents a whole year's worth of interest. So we're going to multiply that times 8 months out of 12 months. So 8/12 is all the interest that we're going to get right now. So we'll end up with $240. So that will be our debit to interest expense, and since we're not paying it right now, we can't credit cash, so what we will credit is interest payable. Now remember that liability account for later, because what we've done is we've set up an amount that we owe somebody. Okay, so we only owe them 8 months worth of interest at this point, but then in the next year when we pay off the equipment, we're going to get rid of that liability because we no longer owe it to them. We're paying it at that moment. So then that liability will wash, and it looks like this. So the first thing you want to do is get rid of that interest payable that you just set up for $240. So that's our our debit right here for interest payable of $240, and then we're also going to get rid of the notes payable, which is the face value of the note, the $12,000. And if we credit the amount of cash that we're going to have to pay, which is the interest for a full year, so that's the $12,000 principal times the 3% interest rate times 12 over 12, which is 1 year's worth of interest. The whole principal plus interest is $12,360. We wouldn't be in balance without this entry right here. The second one is the debit to interest expense, because what we need to record here is that we have still used their money for 4 months in this current year. So we'll need to expense out 4 months of interest here. So you take your principal, $12,000, multiply it times 3%, and then multiply it times 4 over 12 and we get $120. Now we're in balance, and we have recorded properly the interest expense for this current year in the current year, May 1st, 2016, and we got rid of the liability where we accrued the interest from the 8 months that we used their money in the prior year. So that's it for this one.